All right, Hunter. What do NVIDIA, Bitcoin, Microsoft, Google, JP Morgan, what do all those companies and assets have in common so far this year?
I don't know, but I feel like you're going to tell me.
I absolutely am. And they have all had stellar performance, all up, roughly 20% or more year to date. But what they also all have in common is that they have underperformed gold. Now, that's what we're talking about on our podcast today. All that glitters is gold in the market right now. And it's fascinating to see gold has increased roughly 60% year to date and just has no signs of stopping as it almost continues to accelerate as we get, closer and closer to year end. And so what I want to talk about with you, what I want to, give some information to about our listeners is exactly why that dynamic is happening, what are the factors at play, and what we're looking at as far as forecast for gold into the future.
Yeah, and I think this is an interesting one because there are a lot of forces kind of all moving in the same direction. We've talked about this a little bit, kind of hinted at it on prior podcasts about how it's, kind of well positioned from both a risk on and a risk off investor mindset. And so, it's nice to have a good list of all the things that we're watching because it's a lot of very tangible things. A lot of times when we see assets take essentially a parabolic rise, there are a few underlying reasons, but few times is it so well, fleshed out and documented on really these are the forces that are moving it, which I think makes gold a really interesting space to look at.
Yeah, and I think first and foremost for our listeners, and as we get into this conversation, I want to set the stage by talking about, what results in an asset increasing in price. Well, if we're going to go to Economics 101, that's supply and demand, right? So how many buyers do you have versus how many sellers? If you have more buyers, they're going to, sellers are going to demand a higher price for it, and that's going to lead to increased price over time. And that's what we're seeing play out. But whenever you see something get squeezed, especially if you're talking about something that's up 60% year to date, typically you're thinking, hey, maybe that asset value is a little bit smaller. There's not that much supply out there. So a little bit of demand can really lead to higher, price increases. That's not the case for gold. Gold has a $27 trillion market cap. That's, 6 times the world's largest company, which is NVIDIA. So you're not talking about a small asset class or a small, asset that you're talking about when you're comparing the supply and demand dynamics. Now, what we're going to get into as far as the drivers, we will talk about those underlying dynamics and why it is pushing gold's price up. But I think it's important to set the stage in saying that this is not a small asset and a rise in price like this is very significant.
Yeah, and I think that kind of goes to show, the amount of dollars that we're talking about here, because this is a global phenomenon. It's not isolated to one country or even just one country's stock exchange. NVIDIA is a global company, but gold has, you're talking about the money of governments behind it that are moving this. And, kind of leading into that is one of the biggest things that we've seen year to date, especially for the first half of the year, was a drastic dollar devaluation. The value of the dollar relative to other currencies has dropped quite a bit. It's come in from, dollar was at highs. So that's portion of that is very understandable. And then, like we've talked about on prior podcasts, there are different reasons for the drop in the dollar. But as those dollars become worth less, other currencies, and gold I'm including in that because it acts like a foreign currency in this way of it goes up in price because it just takes more dollars to buy that foreign currency.
Yeah, I think you made a really good point. The international dynamic to gold is that it has value all over the world. Everybody looks at it as a unique asset that they want to have ownership of. And when you're talking about, the US dollar declining roughly 10% on the year, especially the first half of the year, that really drove the increase in price. Now, that wasn't necessarily a supply demand dynamic for gold itself, but it was saying that, hey, the dollar's worth less. That means we're going to have to use more dollars to buy every ounce of gold. So that led to that kind of first leg up. And a lot of that, of course, was off the back of tariffs and geopolitical uncertainty, which led people to kind of step back from the dollar to some extent. But we have seen the dollar stabilize. But I do think that's kind of the first and foremost thing to note as far as, what kind of ignited gold's rise Well, kind of started off with that dollar devaluation story and then got into some of these other dynamics. Now, I think number two, which has been huge and continues to grow, is central bank demand for gold. A lot of central banks in the world are looking for an alternative, store of value that isn't necessarily the U.S. dollar. Historically, central banks all over the world have held a large amount of U.S. treasuries because the U.S. dollar is looked at as the most stable, safest currency in the world, and the U.S. Treasury is always going to pay you back the dollars that you invest. Well, I think countries are continuing to buy U.S. Treasuries and hold them in their treasuries and in their central banks, but I think they're also looking for alternatives now. You've had a lot of geopolitical shakeups over this year, specifically with tariffs, trade, and U.S. political dynamics. So kind of shifting the mindset to, hey, maybe we want something that's not attached to any specific political system, and gold is a great option for that.
Yeah, because you saw that especially in China, traditionally huge buyers of U.S. Treasuries. They've continued to buy, but their levels have remained about the same, really, as they roll off buying new ones to offset that, but not really increasing their stores of U.S. dollars like they have in the past. And so, them looking for a third option is understandable. And most of the world, like you said, is just wants that additional hedge, because even if the US dollar isn't the problem, something like gold gives them greater flexibility and greater insurance against any one particular government. We've seen in the past where there's been, decent inflation and currency devaluation across the globe. So whenever you're looking at your foreign currency cross rates, your US dollar to euro might not be changing very much. But if all currencies are devaluing, they all look the same to each other, but then gold, keeps moving up, something like that that's not correlated to a specific government. It's like the old saying of, when you're in quicksand, you're all sinking. But looking someone straight in the eyes, that cross hedge or that cross rate looks the same because you're sinking at the same rate. It's not until you look at something like gold and see, oh, okay, our value is actually declining here.
Right. And I think that's an excellent point. When the whole world is kind of devaluing at the same time, another great way to say that, and something that we have on our list to talk about, is inflation. And gold has historically been looked at as this kind of inflation hedge. It honestly hasn't really moved in tandem with inflation because so many dynamics play into gold that can be all over the place. Sure, maybe on a very long time horizon, but it's outpaced inflation by a significant standpoint. Especially if you're looking at 3-5 years, even it's grown a lot faster in dollar value than inflation has grown. But to your point exactly, if all international currencies are witnessing inflation, or in that case a dollar or currency devaluation, then the price of that gold is going to continue to increase. So that's yet another driver that's contributing to that increase in gold price.
Yeah, and so that's they're all related, and that's one where they're very closely related. Whether it's inflation broadly or inflation between countries, all of those dynamics are important in this. Additionally, along the same lines still, is you have the dollar and currency inflation portion of it, but you also have the country's ability to back up their dollar. That's a concern. And so the U.S. Treasury has been under more and more scrutiny this year and even last year of the amount of money we're spending, concerns that we're digging ourselves in too large of a debt hole to get out of. And so concerns about that have people running away from U.S. dollars, U.S. treasuries. You might trust it in the short term, but do you really want to extend out 30 years? Maybe not so much, because you have those concerns about the just total national debt load overhang. Gold doesn't have any debt. You don't have to worry about that with gold or commodities. And so that's just one more driver where if people are concerned about bonds, concerned about the U.S.'s ability to pay back their debt, that you don't have to worry about that with gold.
Right. And I think that's where you get to the point where you're asking, why are investors looking to gold in this scenario? I think you answered that really well. And this is part of the broader story of they're looking for security and stability, right? So if you're not convinced that your financial system is in a very good place, in this case, high debt, high deficit, an untenable fiscal situation, well, you're going to look for a secure asset. And that's, that could be a variety of assets. It could be company stock, but in this case, certainly gold. And I think that's where you get to the interesting factor of traditionally gold is like the safe haven asset where you would expect the stock market to be going down in a case where gold is really ripping to the upside. This year is not the case. You've got the market at all-time highs. You've had significant growth year to date in the stock market. And a lot of it is because investors are looking for those alternatives to the dollar, to U.S. Treasuries, finding something where they're not convinced that companies aren't going to perform well this year, so they're continuing to buy equities, but they're also looking for alternatives. And all of these factors combining really drive that. And I think what we're seeing is this last phase of gold buying. I think it started with the dollar devaluation story early in the year. I think it's carried through with the central bank demand and international treasury demand. And now I think the story is really investor positioning and how well positioned investors are in gold. Because if you look at central bank buying, traditionally they're going to buy that gold and they're going to hold on to it. They're not typically, trading in and out. It's not a hedge fund where they're trying to, buy high and sell low. They're going to buy that gold and they're going to hold on to it for that safety and stability. The central banks are. But investors, well, right now they're underexposed to gold, so they continue to buy more.
Yeah, we were looking at it and it was less than 40% of, institutional investors own any gold. And those that do, the allocation to gold is at or near all-time lows. And so you have an investor who's not prepared generally for all of the, for the move in gold price. And now you have a bunch of people rushing to catch up with that, which, is generally a shorter term market force, but a very real market force when you have a whole bunch of underexposed professionals who are supposed to be anticipating things like this and getting ahead of it, which is, I think, really interesting. To take another look at something that's been, kind of going back to the inflation story, back to what's been a holdup for gold over the past few years has been interest rates. So gold being a non-yielding asset, you hold on to gold, it gives you nothing back. If you buy treasuries, they pay you interest. So you're earning that, call it 4% on your money market over the past few years. Well, that's a lot nicer than 0% from gold. And I think that may be why it took so long to see, like we were talking about with inflation. Well, we had inflation 22, 23. Well, maybe those effects were, delayed until now, because the cost of owning gold was so high. And now with the Fed funds rate finally dropping, it's becoming cheaper and just more attractive to hold gold, less costly as far as opportunity costs, if you want to throw some economic terms in there, to hold it. And so now people, can finally realize those gains in gold that they've kind of been expecting to see.
Yeah, that's a really good point, because if you're looking at safe haven assets, a lot of people think first cash. So if I'm worried about what's going on in the fiscal environment, I'm worried about what's going on in the stock market, cash, and they think about gold. Mm-hmm. Well, cash can be more attractive in this higher interest rate environment, because when the Fed funds rate is north of 4%, you say, hey, I'm going to throw my cash in a money market, extremely safe short-term government debt. That's yielding you 4%. If you put it into gold, are you yielding anything? You're not. So I think to your point exactly, as interest rates continue to drop, you're seeing those money market yields go below 4%. They're going to continue in that direction. People are going to look to gold as that safe haven asset more so than cash, especially now that they're seeing some appreciation on it. And what you're really getting is that carry on kind of momentum trade into gold, where people see, oh my gosh, gold continues to go up. There's a lot of demand for it. I can get some pretty nice returns here while having that safe haven status of the asset that gold is.
Yeah, and we were looking at it earlier, and the gold options market expects that in the next about quarter for it to, your base case is what it's pricing in is a 5% increase. Well, that's 5% in a quarter. And so that's looking a lot more attractive to investors than your 4 and now sub 4% on cash. So it's turned from a safe haven over here where I'm just going to get my coupons to a safe haven over here where I'm going to actually outperform. And, like we started at the top of the episode, has vastly outperformed everything else year to date, while still being a safe haven. So it gives that, return on equity, even if you're not, generating that cash yield that people are used to with the money markets.
Right. So let's kind of go through now our outlook and where we think gold is going. Will this run continue? And I think if you step back through the factors that we mentioned, not many of them are going to change very quickly. Yeah, I will say that we already kind of noted that the de-dollarization or the devaluation of the dollar really happened in kind of the first half of this year, and that's more or less done. So you're probably not going to see much dollar weakness from here, or necessarily too much dollar strength until maybe trade tensions settle or tariff tensions settle, and you get the kind of a remedy to the debt and deficit. But that could be a long time coming. We haven't seen too much movement in that direction, but that'll be something to monitor. But that's a slow developing situation, so we don't really view that as changing. Central bank demand seems like it's going to continue on. That's not going to turn very quickly. Geopolitical instability kind of continues, and so people are still looking for that safe haven. And so a lot of these factors I think will continue to drive gold. We just mentioned investor positioning is very low. So until you see investors further step into the gold market and make that a sizable portion of their portfolios, it looks like there's going to be buying power behind gold. Maybe not another 60% year next year, but seems like the demand is going to continue to outstrip supply.
There's definitely cash on the sidelines waiting to enter the trade because, like we've said, that positioning is really low. Something interesting that we've seen that I kind of expect to continue to see in the same vein is other precious metals, silver, palladium, platinum. You're seeing those catch up. Silver's done very well year to date. And a lot of that was catch-up trade to gold. You don't have the same dynamics of central banks buying and holding silver in the same way that you do gold. It's simply not expensive enough per pound because, the gold that they already store is massive quantities, but silver is, about $50 a pound right now, or an ounce, excuse me. And so, that takes a lot more space. It's a lot more difficult, and it doesn't have that traditional currency behavior that gold has, because gold's been used as a currency forever. Silver, not so much in the past, 1,000 years.
Yeah, I think you're making an extremely important point there, where gold has a lot of these sustainable drivers behind it, institutions, central banks. I think the movement in these other precious metals is a little bit more speculative. Granted, they're going to kind of trend with gold regardless over time, but you have more investor positioning influencing those markets. So if all of a sudden investors decide to get out of precious metals, it's going to more dramatically impact, your silver, your platinum than it would a gold, because you don't have the same buying dynamic where you've got central banks on one side accumulating gold, whereas they're not really accumulating these other precious metals. So I think that's really important to think about.
Yeah, I think that's where you're seeing a lot more of the FOMO trade that we've talked about.
And so I think that kind of wraps up our conversation around this. We're going to continue monitoring these dynamics, of course, but at least right now it doesn't really seem like there's too much in gold's way. Even if you say the stock market turned to the downside, I don't really see that the investment thesis for gold changing too dramatically. Granted, there's no telling that you're going to see the continued levels of demand. And I will make one quick note on the supply side, because I started off this conversation with supply and demand and the economic principles. Gold supply is only really increasing roughly 1.5% per year right now as far as what's being mined out of the earth. So, and that's not something that can ramp up extremely quickly. So all of a sudden you're not going to see some huge flood of supply into the market. So I think that's important to note when you're thinking about these dynamics. It's going to be mostly demand driven. And like we said, I think these factors more or less stay in place. And so we probably will see continued upside to gold, in the near term and over the longer term.
Yeah, that makes a lot of sense, and kind of goes back to gold's inflation rate at 1.5%, where most central banks right now would go to extreme measures to get their own inflation rate down to those levels. So that's, another tick in the gold column for inflation.
Absolutely. Well, we hope you enjoyed this episode, gave you some good information about gold, the underlying dynamics. If you have any questions about gold or precious metals or our commodity outlook, please drop us a comment on YouTube. And Hunter, I'm sure we'll be doing another podcast on this sometime soon, but certainly interesting to follow, what's typically kind of a boring asset class, but it's certainly been exciting year to date.
Yeah, definitely. Definitely interesting times in the markets.
Thanks
Victor.